What's going on, guys? Raj back again, and today we're going to take a look at Dropbox. So full disclosure, I'm actually long Dropbox, but I'm actually bearish in the long term, but bullish in the short term. So I bought around here like 19-ish dollars. And the reason I bought it at there was because I believed it was undervalued, and I kind of feel like the market is kind of picking up on that right now. But in the long term, I'm actually very bearish on this company because there's no real moat to the company. And we'll kind of go through a short report that I read, and I basically agree with all their points. And I don't really see too much upside in this company in the long term. But when you go on things like Yahoo Finance and the comment section, a lot of people are really bullish on this company, and I can't really figure out why they're bullish. Because I did a pretty good analysis on the company fundamentally and from a strategic point of view. And I couldn't really find anything that the company or Dropbox does better than other companies. So it's really hard for me to buy and hold this company for a very long period of time. So like I said, it's pretty short-term play for me. I'm already up 20%, so I'm pretty happy with that. And overall, another reason why I kind of bought Dropbox was because, like I said, it's undervalued and I don't have too much exposure into the market right now. So I'm just trying to pick up stocks that are undervalued, and eventually the market's going to pick up on those as well, just because we're sitting in an environment with low interest rates, a lot of QE, and a lot of easy access to money. So a lot of these undervalued stocks are going to eventually reach fair value, in my opinion, and that's probably the time to sell out if you really don't believe in the business model like me. Like Dropbox doesn't really have a competitive advantage, so I don't really see a reason why I would stay in this stock for the long term. And we're kind of also going to run through things that these big YouTubers aren't really telling you guys, and we'll kind of do a more deeper analysis of what they're actually letting you guys know. So let's get into it. So this is a report by a short company that actually specializes in shorts. So this is Spruce Point Capital Management. It's a 60-page report. I'll post a link in the description if you guys also want to go through it. And basically the first thing we'll go through is their executive summary. So basically it starts off by saying that they're in an increasingly low value added industry. So by that, it basically means that there's three big players. So Microsoft, even Apple's getting into it, and Google. So there's not really one thing that you can even point out for those companies that one company is doing better than the other. It just kind of comes down to what company you're already integrated with. So that's really the main point, and that's the reason why people are actually picking the cloud storage. So if you're with Microsoft, you're gonna go with the Microsoft product. If you're with Google, you're going to go with Google Drive. So Dropbox is kind of like on the outer edge, you can say, because they're not integrated very well within these platforms. So you kind of have to go out of your way and pick it up. And that's one of the reasons why I'm kind of bearish. And they're kind of missing the boat on the remaining the TAM. So file storage and sync competitors such as Box, as well as other new entrants, are focusing on their efforts on enterprise vertical, where companies are increasingly looking for file storage. So we'll actually go through that in a little bit as well. And basically what that is saying is currently a lot of these companies are focusing on the enterprise side, but Dropbox is kind of doing the opposite. So their main customers are small businesses and individuals. And a lot of these individuals aren't actually paying for their service. So these guys have 600 million users, but only about like 2 to 3% are actually paying. So they have a very low conversion rate. And next is not too sticky. So customers base give a new reason to switch. So basically, if your storage is, let's say you're with Dropbox, your storage runs out, what are you going to do? If you don't really want to pay, you're going to move to something like Google Drive. So there's no real loyalty because Dropbox isn't providing you with like a very superior service compared to their competitors. Then over here, they go through a couple other things. So cash flow potentially misunderstood. This part I don't agree with because they're adjusting for stock-based compensation. So this part I'm going to kind of skip because I don't agree with it. Then here they just kind of give their adjustments and what they think the downside is. So this report is from June as well, but I think it fundamentally has stayed the same. So their downside was $6.60 to $13 per share. So they're basically down on their short if they did go ahead and short it. But this is a long-term play. Like in the short term, we're in a market where like it's pretty crazy, so you can't really judge the report based on what's going on right now, because fundamentally what they're saying is probably going to play out over the next couple of years. So I have no issue with the price being up. So next, here are some of their competitors. So even like the big YouTubers, they mentioned, okay, the TAM is huge. So like if there are a lot of competitors, that's just the nature of the business. But overall, so Google, Apple, Microsoft, even companies like Box are getting into it. So overall, you're competing in a very crowded space. So Dropbox is trying to like integrate more services. So they came in and added the signature service, HelloSign. But the thing with that is HelloSign is actually kind of its own service. It isn't, it's integrated well, but it's its own thing. So like when you sign up for Dropbox, even if you get the most premium plan, you only get 3 signatures. So HelloSign is a completely its own beast. So I think you can't really say that it is part of the company, but overall it's kind of its own product. So in that case, it doesn't really provide that big of an edge, because it'd be a different story if HelloSign was free with Dropbox, but to get HelloSign, you actually have to go in and purchase it separately. So it's not really providing a competitive advantage in that sense. And next, so the next thing is they went over and showed Dropbox searches. And this is kind of an old report, but even if you look now, so over the past 5 years, Dropbox searches have actually been going down. They're basically at their all-time low. So that basically means that people aren't searching for Dropbox, so they're not even considering it when they're looking for something such as a cloud storage service. So if you compare this to something like Google Drive, it's kind of the opposite. So Google Drive has its ups and downs. And let's see OneDrive as well. So OneDrive is a little bit different, but it's a little bit difficult to interpret, sorry, just because it's kind of on a flat line, but you kind of get the point. So overall, like Dropbox, its search traffic is actually decreasing substantially over the past 5 years, and that's probably not a good sign if you're looking at investing. And next, so they gave some so the main thing that people overlook sometimes is like by not going on Reddit, Instagram, and Twitter, and even Facebook to look what the customers are saying. And that's a very big mistake in my opinion. Like here, they only point out the negative comments, but I actually did my own research. And if you go on like the App Store or on your Android or Reddit, it's the same thing overall. Like there are good reviews, don't get me wrong, but overall, like it's a mixed bag. So like this company is clearly doing something wrong and they're not really satisfying their customers. And so like this is a short report, so it kind of is biased just because they're only going to show the bad comments, but just go look at it yourself and it's basically the same thing. So like you'll have good comments, but you'll also have a lot of bad ones. So that isn't really a good sign. And next, so this is what I mentioned before. So a lot of these companies are focusing on the enterprise side, and what Dropbox is doing is focusing on small businesses and individuals. So they're kind of split out all like within the 3 business segments. But the thing is, like, they're not doing one thing really well. They're not catering directly to the enterprise customers. They're not directly catering to individuals. So they're just like, they're in too many businesses in a sense. Like a lot of these other companies like Box, they're focusing just specifically on the enterprise side. So like you don't want to be someone who's trying to do too many things. And that's what Dropbox is currently doing, because like the needs of an enterprise is going to be different from the needs of an individual. So that's basically what this is saying. You could say this is their advantage because they're catering to everyone, but you can't be a master of all crafts. You kind of have to go in and focus on one particular thing. So let's look at from like a more of a financial side. So 2017, they had a really good year. They grew 31%, but basically every year since, their growth rate has actually slowed on a revenue basis. There's other things you can look at. You can look at like billings, bookings, remaining performance obligations, because the way these companies actually record revenue is a little bit differently because they're SaaS companies, so they might actually collect revenue like upfront, but when you recognize revenue, it's a little bit different. But just for the sake of simplicity, we're just going to look straight at revenue growth. So 2017, 31%. Then basically every year it's actually been slowing down. So 2018, 25%, then 4-year 2019, 19%. And a lot of this revenue growth hasn't been driven by users. A lot of it has came from just users paying more because they did increase prices, if you didn't know. So we'll get into that as well. And basically here's their paying users. So they have like 500 million users, but like for Q3 2020, they only have 15 million paying users. So that's kind of troubling to see. And year over year growth in users. So 2019, they added 13% more users. 2018, they added 15% more users. So they're not adding that many users either. Like we could go back, like I didn't add it here, but if you do go back, it's actually slowing down again. And overall, like the company, it seems like the growth is slowing, and you could just see that from top line growth. Like 2017 was 31%, and now we're sitting at 13.8%. And a lot of this revenue growth is also coming from getting more money per user. So 2017, they were getting $111 per user, and now they're out at $128. So that's pretty good to see. And that's like, from this section, like from a strategic point of view, the company doesn't have a moat. So if you're a fundamental investor, like if there's no moat, you probably won't invest in it. But from an actual financial point of view, like if you can get in at the right valuation, like kind of like what I did, then you could kind of like hold it for maybe 1 to 2 years and maybe get off on the right boat. But if you're looking at it as a long-term 10 to 15 year investment, I don't really see that, because even though growth is slowing, like you're getting a company at like a forward PE of around 23, 24, growing at 13%, and that's pretty good, right? And if they can keep this portion up where they're charging customers more money, that'll actually help grow their business as well. And this user growth, like 13% is all right. Like it's decent growth. But if they can drive more of these individuals to go in and actually get monetized just by adding more value than the other services, that's where actually Dropbox would come in and compete. So overall, those are my thoughts on Dropbox. Let me know in the comments what you guys think. Are you guys bearish? Are you guys bullish? Or do you currently own shares? Let me know what you think of my analysis. So like I said, I do own shares, but like for the long term, this isn't a long-term play for me. Like I got in before this big pop at like 19-ish dollars, like somewhere around here. It was definitely in the low 20s or in the late 19s. So for me, like because it's a valuation play, like I'm not going to look too much into, I'm just kind of just riding the wave because we're in a bullish market. But if I do see any weakness or anything changing, I'm probably out of this company because I don't have a long-term mindset so on this company. And usually I do invest for the long term, but it's really hard to find opportunities at this point because 99% of companies are trading at fair value or trading at an overvalued valuation. So it's kind of hard to find companies if you're not like heavily invested in already. So you kind of just have to pick and choose, and you want to stay invested because inflation's eating your dollar right now. So I'm just trying to get as much exposure as I can. So overall, guys, we'll leave it there. Let me know your thoughts, and I'll see you guys next time.